This is the second of two Roth contribution and conversion videos that I'm doing. The other video, which you can find on my YouTube channel, overviews the best lifetime Roth contribution and conversion strategies for most people. This second video that we are seeing now demonstrates the lifetime tax and wealth impacts of using these optimal Roth contribution and conversion strategies. I'm Larry Russell. I hold a BS from MIT, MA from Brandeis, and MBA from Stanford. I'm also president and managing director of Lawrence Russell and Company. If you're interested, you can look at this LinkedIn profile for me. This is a slide that was used in the first video. So to briefly review, there are two investment models here. One is doing Roth contributions during your working years and losing income tax savings and losing subsequent appreciation and recovering some of those through lower RMD taxes and reaching some break-even point in retirement. Whereas with conversions, you tend to pay lower conversion taxes, you have a shorter period of lost appreciation, and therefore your payback break-even age tends to be earlier. This is just a review as well in terms of optimizing Roth conversions. You can plan to do a series of Roth conversions in low income tax years, which occur after retirement or during periods of unemployment. It's good to build up assets in taxable or non-retirement accounts so that you pay living expenses during those Roth conversion years and you don't have to pull out additional money to live on. You can be careful about how you convert and convert only up to certain of the federal income tax breakpoints. Ages 65 to 69 tend to be the best for doing these conversions, but you can also do conversions after age 70 or before age 65 in early retirement. You can read the details here, or you can go back to the first video to understand this a little bit more. Now we're going to move on to the interactive modeling phase of this video to illustrate the trade-offs between contributions and conversions. The tool we're going to use is an automated lifetime financial projection tool, which also does automated tax projections. It's called VeriPlan, and it allows you to customize your lifetime tax projections. It projects graduated federal, state, and local income tax. It embeds all the contribution and deduction rules and limits for traditional IRAs, Roth IRAs, and defined contribution employer plans. It will project lifetime traditional and Roth contributions. It will allow you to identify optimal years for doing the lowest tax Roth conversions. It also supports automated deductions, capital gains, Social Security, RMD, real estate, and many other tax features. It's important that you use a piece of software that can model your particular tax situation. If you want to know more about VeriPlan for both PCs and Macs for home use, here's the link you can go to. And VeriPlan helps you to make better financial planning decisions by yourself. Just so we don't have to go into all the details where we're in there, we preloaded the model to represent this particular family. It's a 30-year-old married couple, happens to be in New York, which has graduated income taxes. Their total annual income is $120,000. They both have professional careers that are earning good money. Very recently, they bought a $500,000 home. Have a $400,000 mortgage. They still have $30,000 worth of student loans that they're going to pay off. Their living expenses right now are $60,000. That doesn't include the mortgage. That doesn't include any taxes or things like that. They also have a portfolio of $100,000. They're going to invest in a typical 10% cash, 30% bonds, 60% stocks investment strategy over time. They plan to retire at age 67, and they plan to fund their IRAs and their 401k as much as they can. They're also going to have 2 Social Security checks in retirement. Now, these are the detailed assumptions, and I won't go into these. I'll leave this up for just a little bit in case you really care to take a look at this. But this is just a question of saving ourselves time from inputting this data. So we can move on to the Roth analysis. This is the income inputs worksheet for Veriplan. There are other videos that you can look at that explain all the details and functionality of Veriplan, so I won't go into all the details here. Let me just give you an overview of the layout. There's these red tabs are informational worksheets. All of the yellow tabs along here are the input worksheets. There's a summary of inputs down here. Veriplan is built on top of Microsoft Excel, so you can use the standard navigation buttons down here to the side. All of the blue tabs are the graphical outputs of Veriplan. If you scroll further over, you can see the green tabs are the combination of the data that's used to draw all of these graphics here. So there's an example right there. And then there's also the comparison tool that we'll get into later on over here. Now let's go back and take a look at a couple of the projection graphics. The first one we're going to look at is the tax payments graphic, which is here. And as you can see, first off, to get an overview of what graphics are like, all the graphics have an age 18 to age 100 scale. Most of them, almost all of them, are dollar based. In this case, tax payments are an outflow, so they're presented as negatives. In this case, you can see that they're beginning at age 30. They have various tax categories such as federal earned income, state earned income. They also have this, for example, is their real estate taxes, and then there's also the withdrawal of Social Security taxes and Medicare taxes here. They retire at age 67, so these are the low income years here. And then subsequent to that, you can see that their real estate taxes continue. This large blue area here is the RMD taxes. The next slide we'll take a look at is the total assets graphic. Again, it's on the scale of 18 to 100, begins at age 30. The reason why assets are pulled below is because they're all being offset by the debts that are owed. This area here is the value of their house over time, and this area here is the stock investments, this is their bond investments, and this is their cash investments over time. The last graphic we'll take a look at this point is the asset taxability graphic. The asset taxability graphic shows the breakdown of the overall portfolio measured on this axis over here by the type of account. This relatively light green area is those non-retirement taxable accounts, assets you may hold. This area is the traditional retirement account assets area. And if there were any Roth accounts, they would graph below that, and we'll see that later on. Now, if you take a look at this dashed line, this is the actual required minimum distribution on an annual basis. This is not the actual tax paid. This is the amount of the RMD that would be required to be pulled out and be taxed over time. And that's graphed on this axis here. And as you can note, it starts at age 72 at this value, and then it goes up much higher by the time you get to around age 92. And that's because the RMD calculation formula is backloaded, and the RMDs are higher the older you get. One final thing to note with this graphic is that over time, this couple always has at least some taxable assets. That's because Veriplan has a control that allows you to make sure you're not taking everything and putting it into tax deferred retirement accounts or Roth retirement accounts. And we'll see that in just a second. Now I'm going to return back to the Tax Advantage Plans input worksheet so you can see where we begin to make the changes to be able to compare contributions and conversions related to traditional accounts and Roth accounts. So this is the input worksheet. First off, just so you can know that the earner number one of the two earners actually has a 401k plan at work and the other person does not. If they did, you could simply select it from here and put it in here, but in this case, they do not. So there's a lot of functionality here, and we'll skip over most of it because this is just designed so you can set up whatever kind of retirement plan or plans you may have. But if you get down to this section, this is where you set the control over annual contributions related to your positive cash flow. So in this case, what they're doing is they're saying that, okay, the maximum percentage in any given year when they have positive annual cash flow that they'd be willing to put into a retirement plan is 90%. If we move on to the next couple of sections, this overviews the evaluation of contributions conversions into Roth accounts, and it's the same topic as what we're doing in this video here. The next section is where you set the Roth contribution limitation tool. That's how you can vary the amount of your contributions over time that you add into Roth accounts versus traditional accounts, and it's simply done by a percentage. In this case, to start out, this couple is putting nothing or 0% into Roth accounts, and the proper inputs would be anywhere between 0 and 100%, and we'll get into that in a second. The next section, oh, by the way, and then this is the setting that allows you to indicate whether or not the 401k, 403b, or 457 plan that you may be in allows a Roth contribution option. If it doesn't, you would set this as a 0, and therefore the only potential Roth contributions you would make would be associated with IRAs. The next section is where we identify years where it'd be most appealing to make Roth conversions. And as you can see, the years 67 through 70 is where they have the most opportunity. I'll get into this later on as to how you use this thing. Oh, and by the way, I mentioned earlier in the presentation that the contribution and conversion rules for traditional IRAs and Roth IRAs are just, I call it overly or ridiculously complex. But here they are. Here's what's embedded. It's basically, I won't go into all the details on this thing, but you have to figure out what's your filing status, whether you're married, its age. It will control how much you can contribute, so you have to identify which line you actually happen to be on, and it'll be able to then figure out what the rules are related to how much you can contribute, and if you contribute, how much of those contributions might be tax deductible. The good news is that this is all automated within Veriplan, and you don't have to worry about that. Now we can proceed with doing initial analysis on whether or not contributions make any sense for this couple. One thing you should note is that with a spreadsheet, every time you make a change to a spreadsheet, everything else that's attached to the change is going to be revised. So this makes it a challenge for people that use spreadsheets to do comparisons of one model versus the other. But Veriplan has solved that problem, and I'll show you how we solve it here. Back here is the comparison tool. This first slide explains how it works, but I'll just simply show it in action, and you can see that it's quite easy to use. Once you develop a relatively final projection model for your family, you can then use the comparison tool to figure out whether Roth actually makes sense for you and your particular situation. So you take the second of these orange tabbed worksheets, and this is where you can copy all of the data. As a matter of fact, if you want to utilize some of the data output of any of your models, this is also where you can actually copy the data that's output by Veriplan and put it into a separate spreadsheet to do whatever you want with it. But in this case, the way you do this is you simply, there's a couple of ways to do it. They're explained here on the how to compare, but just simply holding down the control key, clicking the A button or the A key twice, and then hitting C for copy. That copies everything that's in the model here. Then you go into paste values. Now, here's where it gets a little tricky, but it's not that hard. What you do is you control twice to be able to select everything here, and then you right click with your mouse and you use the paste special function. When you get to the paste special function, what you're doing is you're pasting in the values here and not the formula. So essentially, you're locking in what the values are of the current model. You hit the OK, and that's it. Now, where you do the analysis is on the plans compared worksheet. This is the layout of all the data being projected out by Veriplan, but in this case, there are 0 values for everything because what we're doing is subtracting the current model from the current model. But once we make changes to the overall model, then the differences will show up here. And by the way, the meaning of the differences will be explained here in the top, and we'll get to that in a minute. So now let's go back and let's just imagine we're going to go to the Tax Advantage Plans worksheet, and we're going to begin to vary and see whether or not contributions to Roth accounts might make sense over time for this couple. So perhaps what we'll do is just simply put in 10%. So what this means is that 10% of the contributions over their working lives that they make into any retirement plan, 10% of those will be Roth contributions, and that includes both their IRAs as well as their the earner number one, his or her 401k. So now let's go back to the comparison tool and see what the implications are. On the comparison tool, only certain of the columns will be affected by changing contributions from 0% to 10% into Roth accounts. So first, if you navigate to the bottom and click on Move to the First Year, it aligns with age 30. This is not going to affect income or expenses or debt payments at this point in time, but it will affect the personal taxes. So let's get the personal taxes column. Now, in this case, positive numbers mean higher tax payments and negative numbers mean lower tax payments. So let's get this lined up so it's easy to see against this over here, that at age 30 through age 35, the personal tax payments don't change. Well, the reason for that is because they're paying both the mortgage as well as over 5 years they're paying down their educational loans. So there's no money left over for making contributions to retirement plans. But beginning at age 36, they're able to make contributions, which means that they're that by the fact that they're making 10% of their contributions as Roth contributions, they're going to pay higher taxes over their their working lifetime. So you can see this column, and it stops when they get to age 66. Now, the good news is that it reverses beginning at age 72 when RMDs begin, and it looks like there's a substantial advantage. As you see, these are thousands, the thousands rather than hundreds of dollars per year. But the question now is, what is the impact of the lost appreciation over time? If you go and take a look at the total assets column, and let's get over here and let's just align this one here. Now we can see what the impact is. that since there's no additional taxes related to this age 30 to 36, it doesn't change. But now you begin to see the cumulative impact of paying higher taxes over time. So as we scroll down, we can see that it still stays negative, and as a matter of fact, it peaks somewhere in what's the highest value that we can see here, probably at around age 77. So lower RMDs in retirement are actually counteracting this, but the trouble is, it takes until, and let's scroll all the way to the bottom so we can see age 100, it takes until age 92 for them to actually break even on making 10% contributions in their retirement plan, as opposed to making no contributions, or sorry, making 10% Roth contribution to their retirement plan, as opposed to making no contributions. Now, let's test another value just simply by going back here and saying, well, what happened if they actually were to contribute 50% of their assets to Roth and 50% to traditional over their working lifetimes? And now let's go back to the comparison tool, which will show us what the difference is. Well, it turns out that instead of the break even being age 92, the break even moves out to age 96. So clearly for this couple in their situation, it's unappealing for them to be making contributions to Roth accounts while they're working, primarily because the average life expectancy of a person is probably in the neighborhood of the early to mid 80s. Now, Veriplan also, if you look at this one, shows remaining life expectancy. So if you're interested, you can actually take a look at this graphic and get an understanding of, given how old you actually let's say somebody who makes it to age 65, what the remaining lifespan is and what their total life expectancy is. So if Roth contributions are financially unattractive to this couple during their working years, what about making conversions in certain years? So to do that analysis, let's go back to the Tax Advantage Plans worksheet. First thing we should do is just zero out the contributions to Roth to 0%. Now let's move down to the section on year by year conversions into Roth accounts. And just to get an understanding of the way this is set up, these columns help you understand the years, the total asset balance that you have in traditional retirement accounts. And this is your entry point where you can selectively add year by year a planned conversion amount from traditional assets into Roth assets. And over here, it gives you an indication of what your adjusted gross income is projected to be for a particular year and the amount of dollars that are still available up to particular federal income tax breakpoints. This couple's lowest income years are ages 67 through 70, after they've stopped working and before Social Security, at least one of the Social Security checks begins, and before their RMDs begin at age 72. And it turns out to be in these 3 years here and this one here, they actually have negative taxable adjusted gross income. So essentially, if they were to make if they were to make conversions to Roth IRAs in these particular years, and I'm going to put the amounts in, I'll just put in 23,000 in this case. And by the way, if you're paying attention to this, you'll note that everything dynamically will change in the years going forward. But I'm just going to demonstrate the fact that this is in these years where they have negative adjustable gross income, they won't pay any taxes, federal or state, on that. They're still left it there. But if you total this thing up, you look at this and you see somewhere in the neighborhood of almost $50,000 worth of conversions in these years. And let's now go back to the the plans compared, and let's see that from the very beginning, there is no question of a break-even period because they never had to pay any negative taxes. So let's get this aligned in terms of tax payments. What this means is by making the conversions in these years here, paying no taxes for that, what's happened is they've reduced their RMDs going forward. And so therefore, the personal taxes being paid are lower. Now, if we scroll over and we take a look at total assets, if they were to be so lucky as to live to age 100, just by having made those conversions in those no tax years, their total assets would be $63,000 higher at age 100. Now let's go back and take a look at what the impact is of increasing our conversions and paying some taxes. So let's navigate back to the tax advantage plans worksheet. And now let's note that this column here indicates the first break point where dollars convert. The first break point for a married couple would be $19,900, and up to that point the tax rate is only 10%. So let's try to capture almost all of that if we can. So in order to get up to $20,000, I can just change this from let's just make that 40 as opposed to 23. That leaves $125 within that tax bracket. Let's add another 18,000 to this, so that'll be 28,000. All right, 17,000 added to that would be 27,000. And just to pick up this down here, let's add another 19,000 to that. So that ends up being 22,000. So now what we've done is we're converting a total of probably 40, somewhere a little over $100,000. And let's go take a look at where the break-even point is for them on this one here. So if you look at the break-even age, this is, again, we're aligned at the total assets column. Their break-even age is somewhere in their early 80s. This leaves them more assets in retirement, more assets that they can leave to their heirs. That is the end of this demonstration of optimal lifetime Roth taxation. If you missed the first video, look for this video on the best Roth retirement strategy. Please subscribe to my channel, and thank you very much for listening.